Hi, good evening, everyone. The last couple of days we have seen very little happening on the dollar rupee. It's been stuck in a 4 5 paisa range with no major movements, despite the fact that the domestic fundamentals continue to be good. We saw the Indian inflation data coming lower than expected, and we saw the production figures, manufacturing figures going up. That really did not lead to any great impact on the rupee. But on the other hand, we saw two major movements in the US. The previous week, the non-farm payroll came in much better than expected, which led to a huge surge in the US yields and consequently a big dip in the US equities. And more importantly, it led to a surge in the US dollar index. And then just a couple of days back, we saw the US inflation data, which came out yesterday, which, although the number which came out was lower than previous months, inflation had dropped from 3.5 to 3.1, it did not really enthuse the market. In fact, the markets went the other way around. The dollar gained again, US yields moved up, and the equity markets dropped. I thought we'll spend some time understanding this. The thing is that initially, for the non-farm payroll, the forecast was, or the estimate of the economists who were polled by the Reuters and other major financial media, they were expecting a hike of 185,000 jobs. They were expecting the non-farm payroll to move up by 185,000. The previous month it was 150,000. Now the people who were polled were the economists, the top economists from the top institutions and banks in the US, who have, I'm sure, very good resources, who have the capacity to spend money to get the best resources and the market information. It is therefore a bit surprising that when they were expecting 185,000, the number came as 335,000. This is flabbergasting. It is nearly double of what they were expecting. So basically, and this was not the first time this has happened. So basically, what it meant was that the forecast of the economists, of the top economists, of the top US institutions and banks, didn't really mean a thing. They were guessing the numbers as much as I and you could guess. But the unfortunate fact was the market had reacted to the expectations of 185,000. We saw the US yields coming down. We saw the equity markets moving up. And we saw the dollars coming down because of that forecast. So corporates and others who were looking at the forecast, who were looking at the reaction of the market to these forecasts, built up their positions. They hedged their long dollar positions, sold off the long dollars because they were expecting the dollar to weaken further, and the data came out 185,000 or even lower. But then when the actual figure came out, they were caught in the trap because the dollar just shot up, everything went up because the number was nearly double. And the sad thing is that nobody asked, neither Reuters nor Bloomberg or any of the financial institutions asked those economists the reason for their forecast being so off the mark. I can understand if I or you make a forecast which is totally off the mark, basically because we don't have access to information. We don't have the kind of financial backing to contact hundreds of people, hundreds of small corporates, hundreds of companies to find out what their feeling is on the non-farm, what have they actually seen and done in the market. But these top US economists, these top US firms and the top economists who are paid in millions of dollars should have come out with a much better forecast. And this is not the first time it has happened. We have seen forecasts of 155,000 being revised down when the final figure came down to 105,000. Nearly a 30% reduction. So either people should force, or the people who regulate these, the Treasury and others, should force such economists not to come out with these forecasts, should prohibit Reuters and others from coming out with such distorted data or forecasts unless they get it right. Because the market reacts on this not only in US but globally. We saw the yields, Indian sovereign yields drop on the basis of 185,000. Now there are a lot of foreign investors who had brought in money because they were expecting interest rates to go down. And this seemed to be the right thing. But the moment the non-farm payroll came in, the yields went up. So those who had invested at, say, in the 10-year bond at about 7.0506 were caught on the wrong side because the yields went up to 7.16. The dollar yield went up below 4, the 10-year went up from below 4% to 4.19. And today it is at 4.31. Basically, why? The reason is that the inflation data came at 3.1. The market was expecting 2.9. The market reacted to the expectations, not to the fact that inflation has actually come down from 3.5 to 3.1. So if you look at it logically, it makes no sense. But it does hurt people who actually, trade not for speculative purposes, but to cover their exposure. Small merchants, investors, all of them get caught. The hike in the interest rates and the yields, the hike in the dollar had an impact on our equity market. Our domestic fundamentals were good, but then our domestic fundamentals do not force the equity markets or the rupee to move in line with that. Basically, because when the domestic market is moving up on the basis of domestic fundamentals, the FIIs join the trend and the markets moved up. But when the markets were dropping overseas because of the distortion in the forecasts, when the actual data came out much better than forecast, it hurt the equities in US. The Dow crashed by 500 points, and that had an impact on our equity markets. So people who had gone long in equity were caught short, were caught on the wrong side. There was not too much of an impact on rupee, primarily because RBI has been intervening continuously for months together, which with the net result that foreign speculative activity on dollar rupee has come down tremendously. You don't see the rupee drop when the dollar rises overseas. 100 basis point rise in the dollar index probably leads to about 8-10 paisa drop in the rupee, which it recovers a couple of hours after opening. But what did impact our market was the yields. So my point is that because, like I said, none of the regulators, none of the financial media, business media questioned the people who had forecast 185,000 on the non-farm payroll as to why their forecast was so off the market. As long as that happens, as long as they are not held accountable, there is, I think, no reason for the regulatory authorities to allow such forecasts to be published or shown on the financial media. Or you make clear the names of the people who are forecasting 185,000. If it is Citibank, say Citibank forecast. If it is Morgan, say JP Morgan. So at least people know that next time the figures by JP Morgan or Citi are announced, the forecast, they will at least look at it twice and probably will not act on that. So this is my point. The point is that when you and I make a forecast, it doesn't carry too much weight because we don't have that kind of clout as the financial institutions in US. But I was also thinking that if the forecasts in India were so off by our top economists, not only in any third world country, any Asian country, there would have been a hue and cry in the Western media about the data being cooked up, you know, or that the economists had no idea what was happening in their own country. But nobody questions the US economists who had forecast such a thing. And this is not something, like I said, happened only recently. It has been happening for months together. And nobody questions it. Nobody, I've not seen a single commentary in any financial media, whether domestic or foreign, which questions these forecasts. So why the forecasts are so off the target, despite the fact that the market initially the yields dropped because the forecast was 185. Then it moved up to 4.31 because of the actual results coming out, data coming out much higher. We saw a movement of nearly more than 25 basis point, which is more than the Fed cut that one was expecting in March. So tomorrow, within this month, if again we see a forecast of say 100,000 for non-farm payroll for February, which will be released in March, the yields will again drop sharply. There might not be any need for the Fed to cut or any talk about it. It makes no sense about rate cuts and all by the Fed if the market is going to just track what the forecasts are. So I thought we need to think about those things. We need to understand it and we need to voice our opinion on it. And that's the reason why I'm making this statement. Because I haven't read, like I said, a single article, a single comment in any newspaper, Indian or overseas, but why the forecast was so wrong, which led to wrong decisions by a lot of people. So if you have any thoughts on this, please do let me know. Thank you.